First, let me thank you for the introduction and the organizers of the conference for the invitation and the opportunity to talk here. And I'm going to be, my discussion will mainly refer to the paper Price of Long-Run Temperature Shifts in Capital Markets, co-authored with Marcelo and Donna Kiku. And as the disclosure says, everything I'm going to say is just my views and do not reflect anything the Federal Reserve or the Board of Governors is thinking. So it just depends on me. As Joe was saying, one key input to implement a climate change policy is a price on carbon. And one thing that we can look at is the social cost of carbon. And as economists, what we have been using to get a number for the social cost of carbon has been usually integrated assessment models. But there are many uncertainties about the inputs we introduce into these models. Like, for instance, we are not sure exactly what the damages of climate change is doing to the economy. We're not sure how to discount these damages. So what I'm going to argue today in my discussion is that we can get information from asset prices about the cost of fluctuations in temperature on the macroeconomy, and that can also give us some guidance about how to design these stochastic general equilibrium models that combine the climate so we can get some measures, reasonable measures for the social cost of carbon. So let me start talking about climate change and the macroeconomy. What do asset prices can tell us about the effect of climate change on the economy? So basically, in economics, what we've had has been like two approaches. One approach has been this bottom-up approach. Then William Nordhaus has been the one that started this, which mainly is what they do is that they start looking at the consequences of climate change on several outcomes at the micro level. So, for instance, you can have health, labor supplies, social unrest, and then kind of aggregate these effects and say this is the impact of climate change on the economy. An alternative approach has been looking at a different, from a different perspective, a reduced form approach, which mainly looks at time and cross-country variations in temperature to try to get a sense of what is the impact of temperature fluctuations on aggregate outcomes such as, for instance, GDP growth, innovation, investment. And there has been some work done by researchers, even some work that we've done, where we've looked at the cross-sectional relationship between temperature fluctuations and economic growth. And we find like short-term fluctuations affect negatively economic growth across the world, but it's easier to identify these effects in developing countries. So some people might say, well, countries like the US are not going to see these effects of climate change. So in this paper, we take an alternative and different approach, which is we base our analysis on a reduced form model, but instead of looking at national accounts, which mainly reflect it's a measurement of things that happened within the period that was this measure. Let's say like GDP last year measures what happened with production last year. We look at equity prices, and that was alluded in the first session as well, because equity prices have this characteristic that they show us expectations about what the future is going to bring. So, for example, specifically we look at what we're trying to get is what investors are thinking climate change, how investors are thinking climate change is going to affect the economy in the future. And it does not only embed investors' expectations about the effect of climate change in the future, but it also met like their attitude towards the risk of climate change. So equity prices are also going to be able to give us a sense if investors are thinking that climate change is a risk. And so let me share some lessons that we get in our paper from equity prices. So what we do is we use data on portfolios, and we form these basic 25 portfolios because they are mainly used in financial economics. And these are comprised of firms that are listed in the main stock exchanges. And what we find is that when we look at valuations of companies, we find that the valuations of these companies, the prices, the equity prices, tend to decline in response to higher temperatures. And consistently, what we find is that a 1 degree Celsius increase in temperature might bring down the value of the stock market of about between 5 and 10%, which is relatively large. We also find that when we look at, if we decompose the fluctuations in temperature between short-run fluctuations, let's say within a year, and longer fluctuations that are more persistent and prevail within like several years, we find that this low frequency component is the one that is driving this negative relationship. So we're thinking it's not that one day it's hot and then investors are moody, or one day it's cold and investors start it's not, there's not like a behavioral channel here. So it's probably reflecting more like a macro channel and more related to climate change. And the third thing that we find is that when we look at these different portfolios, there's a pattern. So let me show you this in this picture. So what we do here is in the x-axis, what is plotting is what is the sensitivity of these portfolio returns to unexpected changes in temperatures. So as you can see, most of them are negative. So that means that's consistent with the negative effect on valuations. So returns, these firms tend to perform very badly when temperature is suddenly large. But there's this difference in the exposure to temperature. And as you can see, in the y-axis, you can see the risk premium on these portfolios. So what this is telling you is that firms or portfolios that are more exposed, so those that have whose values or returns decline more pronouncedly with temperature, for those investors require a high risk premium. So it's not only that investors are thinking that higher temperatures are going to affect the economy in the future, but they're also going to command a higher return. So that's increasing the cost of capital for these companies. In sum, what we find from all this experience is that firms' equity prices can give us a gauge of what are the consequences market participants in financial markets are expecting climate change to affect economic growth. And there also we can get a sense that investors' perceptions of this increased risk of these high temperature scenarios with low growth are there. And that's why they're commanding a risk premium for holding these assets. So how does this help us in this debate about the social cost of carbon? So in our paper, what we find and what we explore is that this empirical relationship between equity valuations and climate change can give us one restriction on what are the sensible models from which we can compute this social cost of carbon. So the first thing that we find is that if we have an economy, we usually have this representative investor. And this representative investor has this utility function, and this utility function is going to be important at the time of computing the social cost of carbon. And what we find is that the functional form of this utility function is going to determine how asset prices react to changes in temperature. So climate change is going to affect differently within the model asset prices depending on the utility function that we use. And for example, what we find in our paper is that if you have a typical log utility function, which is the one, for instance, that used in the DICE model, you see that if you have an increase in temperature, asset prices are going to go up. So that's the opposite effect that you see in the data. We also find that if taking into account the empirical evidence is going to give you bounds on the effects on climate change. So it's going to give you like a lower bound. First of all, because equity prices are not all the wealth that households have. And the social cost of carbon is going to be closely linked to what the effect of temperature is going to have on the wealth of the household. So for instance, you can have real estate, you can have bonds. So there are other sources of wealth, human capital, so other sources of wealth for each individual. But this is going to give us a sense that the social cost of carbon is not zero. There's a value on this. So even if when using just these restriction in our model, what we find is a social cost of carbon of about $100 a ton per carbon, which is high. And this would be for us like a lower bound. Finally, the other thing that's going to give us, that's going to give discipline looking at asset prices is the response of discount rates to climate change. So there's been a lot of debate about what the proper discount rate should be used, but we think that it's also important to understand how climate change is going to change this discount rate. Because as we learn more, we will have more data, we will have more understanding about the risk of climate change. There's going to be also an effect on the discount rate that we want to use. So in our model, for instance, we show that as this risk is increased, then we'll have to change the discount rate to reflect the risk that these investors are facing or that the society is facing. And all these ingredients are going to determine the magnitude of the social cost of carbon. So I just want to end alluding to what Mark was saying at the beginning. Like in macroeconomics, after the financial crisis, what we did was try to have this collaboration between financial economics and macroeconomics. And I think like it's also a good time now to start this collaboration between climate scientists and not only macroeconomists or microeconomists, but also financial economists, because there are important implications from financial markets that I think can inform the building of these models that we use to measure the social cost.